Hi everyone, it's Konrad Bobilak, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple. And today's video is a very interesting one because there's hundreds of mistakes that you can make and do people make, I should say, when setting up and building wealth through property investing. And when I was making this video, I probably came up with a list of about 80 mistakes that I've observed people make over the last 10, 15 years, 20 years being in the industry, and also mistakes that I've made myself when I started building my property portfolio all those years ago. But I've come up with a list of top 10 mistakes that property investors make when setting up and building their property portfolio. And more importantly, I've come up with things that solutions for you or things you need to avoid to make sure this doesn't happen to you. These 10 mistakes, I believe, are the reason why most people fail to build large property portfolios, or they build portfolios that don't work, which means they constantly need income from that person to sustain, where the objective should be really passive income at some stage, or they just get stuck with one or two properties and max out completely. So some of those reasons might be relevant for some of you listening to this YouTube video right now. If that is, stay tuned to the very end, and I've also got a very cool gift for you at the end, which I'm going to give you worth $495. So make sure you watch this video to the very end. Personal disclaimer from myself. My results aren't typical. I'm not going to insult your intelligence by implying you're going to build a multi-million-dollar property portfolio like I have. But I'll show you exactly what's worked for me and give you some pointers on how you can implement similar strategies in the event that you find them congruent with your risk profile and investment time horizon, etc. And if you are becoming successful because of the result of anything that I'm teaching, send me an email because I will take full credit for it. But ultimately, guys, there's no guarantees in life. Life sucks, wear a helmet, as I say, and the only person that's going to make you wealthy is you. So the more knowledge you gain and the more contacts you have with successful people, the quicker you're going to get through the learning curve and the quicker you attain your objectives when it comes to property investing. Some of you have never seen me before in terms of speaking. I won't bore you to death with my credentials, but I want to just point out a couple. I did waste 4 years of my life at Monash University drinking beer at the tavern and shooting pool until I got really bored and doing assignments with people that I hated. But I actually wanted to make some money. So then I got out of there. And I worked in a number of industries, predominantly in the financial planning industry, funds management, lending, banking and finance. I'm a real estate agent, I'm a mortgage broker. But more importantly, I'm a successful property investor, and that's really the only qualifications that I need to teach you guys these things today. Because ultimately, all the credentials behind your name don't equate to anything. All it matters is the zeros in your bank account. That's the most important thing. I'm also an author of Australian Property Finance Made Simple, which you can buy by going to bookonfinance.com.au or Amazon or any good bookshop around Australia. Now, here's the reality of the situation. Before we get into the top 10 mistakes that people make when it comes to property investing, I keep showing you these stats if you watch my previous YouTube videos, and the stats really don't change. If you look at 2013, 2014, 15, 72 or 71.6% of all investors only have one property. Very few people manage to get 6 or more investment properties. In fact, the stats are less than 1%, which is some 19,000 people have more than 5 properties. So there's very few people that are able to do that. And there's some commonalities. There's some traits that are common to these people. As I say, success leaves clues. And what I wanted to do today is show you the top 10 mistakes that I've observed in the last few years that people are making consistently without even being aware of them. And I'm not sure why they do these things, but they do, and see if some of these things you are doing currently, and I want to give you some tips on how to overcome them. So the reason why so few people actually succeed in investing in real estate is because there's a number of reasons, but they haven't got a plan, and most of them have a buy, hold, and pray to God strategy. God, please make this property in Coburg go up in value. Please, I want that red Ferrari. That's probably the only strategy people have most of these days. Most people just buy property because everyone's talking about it. It's in the media. Friends have a property. Hey, maybe we should buy an investment property. And that's fine, and there's nothing wrong with it, by the way. And I'm not going to have a go with someone just for giving it a try. It's cool to have one investment property, okay, and do nothing else beyond that in your house. This video is made for people who want to build a large property portfolios but to get stuck. And you might be getting stuck because of the following behavior patterns, which I want to identify and share with you on the video. Number one mistake is buying your first investment property before developing an all-encompassing investment strategy. So once again, this is not for people who just want to buy one property and just sit on it. If you really want to build wealth and buy 10 properties over 10 years or 12 properties over 10 years, whatever it is, whatever your goal objective, you have to have that objective in writing. And there's really 3 ways you can live off your property portfolio. So I want to show you what this means exactly. Number one is you can just build up your property portfolio, buy your properties standalone through trusts, through different lenders, interest-only loans, never cross-collateralize your assets, and eventually, when you have equity, I'm assuming you've identified the right areas to invest in. When you have equity, you can set up a line of credit or a redraw facility, take the equity out and live off that equity and capitalize the interest. So that's a very aggressive strategy because you're taking on debt, but you are living off the equity and you're capitalizing the interest. And your interest capitalization is sustained by your rental appreciation on those properties. And I did that myself. I stopped working at Medfin and took time out and just live off the equity of my property portfolio. You know, a lot of people think that rental is the only way you can live off your property portfolio. That's incorrect. I'll show you it's one of the strategies, but living off the equity is the way to go. It is aggressive. You have to have the right mindset psychology. Number 2, you can use your line of credit or redraw facility to buy shares or trade shares or buy annuities or something that's income producing. Now, I'm not going to give you financial advice here on this video. That's why you got to get together with a financial planner like Dennis Durand, which I featured in other videos, and he can give you that advice on what's right for you based on an individual assessment. Having said that, that's a very good strategy. We can buy things that give you income streams that are predictable and measurable over a period of time. Number 3, you can sell a portion of your property portfolio, pay off all your debt, and live off the rental returns of your unencumbered investment properties. And this is what I do with a lot of my clients. They might have a goal to buy 5 properties over 10 years, and then they sell 3 properties and pay off the first 2 they've purchased. Why do they sell 3 to pay off 2? You're going to lose one on average with capital gain tax because you've got to pay tax on your proceeds. So as a really rough rule of thumb, if you buy 5, you can work out with your accountant how to sell them correctly, but you sell 3, pay off the first 2. So, very simple example. Let's say you buy 5 $500,000 properties in today's market. 10 years from now, they've doubled, so they went from 500 to $1 million. So then you sell 3, pay off the first 2, which means you've got $2 million unencumbered property. You're going to get a net rental income of about 3%, so you're getting 3% on $2 million, which is $60,000 per year. Passive income, no debt. Now, for some of you, that's not enough. For some of you, that's too much. For some of you, you want more. It's up to you where you go. You could buy 12. It's up to you what you do. I'm just showing you the mechanics of how it's possible. You can also, with that strategy, what a lot of my clients are doing is buying 12 over 10 years, selling 7, paying off 5. So in the previous example, let's assume and simplify just purely for the purpose of illustrating the point that the properties are worth $500,000 each. 10 years from now, they're worth $1 million. So you end up with 5 properties worth $1 million each paid off, which is $5 million, 3% rental yield, $150,000 passive income. So that's a strategy as well. Now, the cool thing is, and this is what I recommend, pick one of them before you start accumulating properties, and then translate that back into property acquisition. So start with the outcome in mind and then work backwards. That's a very important thing. And if you want to, I've done some other videos on YouTube that elaborate more on these strategies. So you can watch some of the other videos or come to one of my live events. But that's the essence of basically identifying the strategy first and working out which strategy is more congruent with you, and then working backwards and translating that back into property acquisition. Mistake number 2, buying the first investment property before setting up your team of independent industry experts. Guys, your team will make or break you. The amount of time the clients have told me the story of, we've got this family accountant, his name is Joe, he's been with the family for 30 years, we can't get rid of him because he did our dad's tax returns and he looked after the farm, and he's a nice guy, but Joe's broke, he's just an average accountant working from home. Guys, you cannot have people like that on your team. Your accountant, your mortgage broker, they have to be successful property investors. My accountant is a property millionaire. He's got millions of dollars in assets that he owns both in residential and commercial property. And I've mentioned this before in a lot of my videos. The team around you will make or break you. You've got to make sure that the people around you are very successful property investors themselves. So specifically, I'm talking about your accountant. I'm talking about definitely accountant has to be a property investor without question. Financial planners also has to be a property investor. My financial planner is a property developer. He actually develops properties for himself, and he's got 8 investment properties himself. So he's a very successful property investor. And that's who you want on your team. Your mortgage broker, they have to be a property investor themselves as well. Or they've got to at least look after clients with more than 10 properties. People that have achieved results far greater than what you want to achieve. Bank is the same. Property solicitor doesn't need to be a property investor. I mean, your lawyers really just do settlements and they check the contracts of sale. Unless you want advice about doing joint ventures or doing things where you're doing, I don't know, things like equity partnerships, or you're doing, let's say, solicitors funding, or you're financing projects. There you probably want to get a solicitor that is a property investor. Having said that, most of the lawyers that I use myself are not really property investors. They are wealthy, they have ownership over property, but would I consider them property investors? Probably not. Probably wealthy people that hold property as an investment vehicle. You also have to get a really good quantity surveyor for depreciation schedules, and definitely your property manager has to be a property investor themselves as well. The QS doesn't have to be a property investor. I recommend BMT QS, which are probably the best quantity surveyors in Australia. I don't even know if they're investors themselves, but I know they give you the highest depreciation schedule for my properties. Property managers definitely have to be investors themselves. They've got to have that appreciation of dealing with tenants and the pain you go through when things go wrong. So that's 100%. There, and also insurance specialists don't need to be property investors. But you can see there, the top 3 or 4 people in your life, mainly your accountant, your mortgage broker, guys, if they're not a property investor, say goodbye to them. I mean, literally, you cannot fly like an eagle if you're surrounded by pigeons. Think about it. Number 3, buy a house located 2 to 5 k's from where you live because you know the area. Buying inside the comfort zone. Now, I have no proof that this is what happens, but this is my idea of how the average person buys an investment property. They get up in the morning on Saturday to go to the newsagents to get the paper and milk. As they're driving through or walking, they see a auction sign. Oh, that's good. What time's the auction? 10 o'clock. Beauty, for an hour. I'll have breakfast and I'll check it out. They go home, they have breakfast, they go to the auction. The house is relatively similar to what they live, maybe a little bit cheaper. They get excited, they start bidding and they win. And then they go, crap, maybe I should have got pre-approval beforehand. It doesn't matter, it'll be fine. Monday they ring their broker and they ring the accountant. Now, some of them sometimes get the loan, sometimes they don't. That's why we have a cooling off period on contracts of sale when you buy at auction. But the ones that do, most of the time, never go any further beyond that first property. And that's why 72.3% of investors, or 72.8, I should say, only have one investment property. And I guarantee you, it's a house that's comparable to what they live in, maybe 10% cheaper, within 3 to 5 k's of where they live. So they can keep an eye out on it in case, they're driving one day and it runs off. Jesus, it's not there. It's a comfort thing. Now, if you happen to live in a good area, like Bowen, for example, or Brighton or Hampton or, Yarraville, Williamstown, that's fine. But what happens if you live in Melton, for example? One of the worst capital growth areas in Melbourne, or Trigonina, Tarneet, or Point Cook. That could be the worst thing you could do because you're not going to get any capital growth. The house might be fine and you might be getting a lot of value for money and you might even get a good tenant. But are you going to make money out of this thing? Because remember, this whole game, guys, is about making money. There's no emotion. It's purely just about making money. So don't buy in the comfort zone. Don't default yourself into this average investment profile that most people take on. Go out there, do independent research, get the top RP data report for the top best growth areas in Melbourne or Sydney or Brisbane, wherever you are, and buy for capital growth. Number 4, buy a house or land package in Melbourne because houses double every 10 years. Okay, houses do not double every 10 years. I can tell you now in Melbourne, there's a lot of areas where house or land packages have completely underperformed inflation, and inflation is around 3.5% per year. Some of the worst areas for capital growth long term. Now, I'm not talking about short-term capital growth, because I can tell you now, at the end of the growth cycle, some of these areas actually have a mini boom because they've done nothing for 7 to 10 years. So I don't want emails saying, oh, Konrad, we bought in Hoppers Crossing and it went up by 20 or 50 grand or 100 grand in the last 12 months. I know, everything eventually has to go up over a short period of time, but this game is about consistent capital growth every year. And I can tell you now, Hoppers Crossing and Tarney Triganina have no growth for years on end, sometimes 5 or 6 years at minimum capital growth. Cranbourne, north, south, east, west, Sandhurst Sky, Doreen Mernda, Derrimut, Point Cook, Werribee, Pakenham, Pakenham South, Melton, Melton West, Roxborough Park, Craigieburn, Clyde, Clyde North, and Epping. These are some of the worst capital growth areas in Melbourne, and I've done a number of videos on why this is so. There's a video that I did called The Great Australian House and Land Traps, so you might want to watch that video too, and it goes into much more detail about what these areas suffer. But if you look at some of the capital growth of these areas, you know, way below inflation. Inflation is around 3.5, 3.75, so how are you going to build wealth, you know, in Melton at 2.5% growth per year, where inflation is 3.5, you're losing 1% in equity every year. So my advice is definitely research the areas and don't just buy house and land, you know, because house and land doubles every 10 years. It doesn't double every 10 years. Definitely townhouses in good areas do, but not in the house and land. Now, if you look at the areas in Melbourne that have doubled in the last 10 years, you can see that they're predominantly the eastern suburbs and the Bayside. And these are the areas that I focus on and I target for when I source properties for my clients. Number 5, buy an off-the-plan apartment in Melbourne because you're priced out of the detached house and townhouse in the same area. A lot of people are buying apartments in places, really good suburbs, top suburbs, like Blackrock, Hawthorne, Richmond, you know, phenomenal areas for lifestyle. And you can't get a townhouse anymore because even townhouses are 1 million, 1.5, 2, depending on which suburb. So people buy a 2-bedder for $650 apartment. Now, massive issues in Melbourne and Sydney with apartments, massive. Melbourne is completely oversaturated with apartments, and this is not even a long-term thing. I think there's going to be so many problems on so many levels. These blue towers represent properties that are being built or about to get built in Melbourne. There's 64,000 apartments that are settling or under construction in Melbourne in the next 2 to 3 years. 64,000 apartments. What are we going to do with them? And this is why the banks have blacklisted these postcodes, like Melbourne 3000, Melbourne 3004, World Trade Centre 3005, South Bank, South Yarra, Docklands, South Melbourne's blacklisted. Great suburb for lifestyle. I used to work in South Melbourne, but not a good area for apartments. So remember, when the banks blacklist a suburb, means the maximum equity you can go up to, or the LVR you can go up to in your property is 80% LVR. So stay away from the areas that have been blacklisted, guys. And you can see there, these are some of the other areas in Queensland and New South Wales. So, you know, they're getting a bad rap. Why are they getting such a bad rap? Mainly because if you look at Melbourne, for example, potential units over the next 2 years, 78,000, right? Which is an increase of 11%, which is huge. I mean, Brisbane's also quite large, 36,000, but Sydney is 76,977. Now, not only are apartments bad for capital growth, there's a lot of structural issues that are coming to light now with the recent stories in New South Wales of a number of towers that are literally, I think will get condemned unless they fix those structural problems. So the problem with those people that have bought into those towers, they're going to have such a bad name now. I won't mention specific companies or anything because I don't want to get sued. That I question where those people will ever get their money out of those apartments. And some of these people have borrowed $600,000-700,000 plus, maybe $1 million plus, to live in these buildings. So consider the fact that for most people, this is probably the most detrimental thing they've ever done. I mean, in Melbourne, we haven't had the same thing happen yet. But I can tell you now, I've been to towers in Melbourne apartments where I think there could be structural issues. And I've definitely seen cracks on walls and water leaking in areas where you shouldn't be leaking. So there's a lot of these building codes, I think, that are not being adhered to. And a lot of these issues really come up with apartments. So if you buy a house or a townhouse, you own the land. So you can always rip down the structure and redevelop. With apartments, you own nothing, you own air. You know, and this is the biggest challenge. If that tower or that apartment complex is structurally unsound, you're stuck with a dud. So I wouldn't be buying any apartments in Melbourne that'll sit there for the next 2 to 5 years. I think when we come up to 9 o'clock on the property clock, which is the growth phase from 9 to 12, some suburbs in Melbourne, which I'll show you in a second, are worth considering for apartments because there's going to be no growth for the next few years. There's eventually going to be some growth, yes, maybe there's opportunities there, but even then I'll be very careful and I would really do my due diligence and research, guys, when it comes to apartments. These are some of the areas, and I've mentioned this before, if you want to buy an apartment in Melbourne, out of the 418 suburbs, there's only 12 suburbs, in my opinion, where apartments actually work. And where they work is where there's a 3-to-1 ratio in price between a 2-bedroom apartment and a detached house. So for example, in Toorak, the median price in Toorak is $3 million, and an average 2-bedder is $672. More than the 3-to-1 ratio, 3.46 ratio. That means that the person that's looking for a 2-bedder in Toorak is completely priced out of the detached housing market or townhouse market. Not even close. So either they live in Toorak, which is the most expensive suburb in Melbourne, or they move on to another area. Then, yes, under those circumstances, as long as the complex is boutique, like I'm talking about 15, 20 apartments, quiet street, maybe in the school zone, yes, worth considering. But other than that, I wouldn't touch it. So some other areas, St Kilda West and Kew, Garden Vale, which is Brighton, Armadale, etc. So there you have a 3-to-1 ratio. Where apartments don't work in Melbourne is places like Dandenong, for example, where you get a 2-bedder for $650 or you get a house for $850. It's too close in price point. Apartments will never work in Dandenong. Or Caroline Springs, they're building apartments. God knows why. It's never going to happen. So you buy it, you'll get 1% growth, so you're going to build your property portfolio by the time you're 95. I mean, it's just pointless. Remember, it's all about house income demographics. If you want to know which areas are going to go up in value, look at the areas where people are making the most money per week as a household or an individual. So in Melbourne, for example, this is median household weekly income. Park Orchard, $2,660 per week. Plenty. Cremone, which is Richmond, $2.5 grand. Ivanhoe, Wonga Park, Canterbury, etc. And this is only one methodology, but if you look at the personal income as well, this is probably something that I would look at definitely when considering an area. Richmond, East Melbourne, Port Melbourne, Middle Park, Toorak, Elwood, Albert Park, St Kilda West, Clifton Hill, South Yarra. Now obviously this is one methodology. South Yarra I wouldn't touch apartments in obviously, but this is an area where I would look at income per household and focus on areas with the highest discretionary income because they have the ability to push property prices up. If you're looking at an area where the average person is making $600 a week, I mean, what's the borrowing capacity of that individual or household? It's going to be very limited. Therefore, there's going to be limitation imposed on capital growth potential of that area. Number 6, buy properties for cash flow rather than growth. Inner city blue chip areas versus outer area cash flow positive properties. Now, this is such an important topic and people get this wrong all the time. The difference between the rich and the poor is the rich always grow equity and capital. That's why it's called capitalism. They buy capital and then they grow their capital base, which means they buy growth assets, residential, commercial property, and as the asset appreciates in value, the rental income that it sheds increases as well. The poor and the middle class, and to a large extent uneducated people, chase cash flow because they think, well, I'm making 50 grand a year, I'm making 100 grand a year. If I could just replace that income, everything will be fine. Well, it doesn't work that way. And I'll show you something very interesting. Growth properties are superior to cash flow positive properties, both in capital growth and rental income long term. So let me give you an example of $300,000 because you still can go regional, and you can't get much for $300,000 anymore, but you can still go to like Bendigo, Ballarat. Maybe you can get a $300,000 house and land package in those areas or in all the Victorian property. If you can't, you can't. Usually they're probably closer to the $500,000 mark. But anyway, I'm going to show you $300,000. And the first example is a growth property, which means it's got 10% growth and 4% rental yield, which is kind of a blue chip area property. That's usually the stats of like Elwood. You've got 10% growth, 4% rental yield. And then I want to show you an area where it's getting a 10% rental yield. So it could be a regional town or a mining town, but the growth is really low, 4%. Which is usually associated with those areas. And you can't have both, by the way. If you get both, they're not sustainable. Like Karratha, South Hedland, Port Hedland, you had both capital growth and rental yield, and what happened? It all collapsed. So long term, you can either have one or the other. Now, starting off in the first year, this property goes up to 330, and you're getting 13,200 in rental. This one goes up to 312, but you're getting 31,200 rental. You virtually nearly more than double compared to that one. But what happens is you go through and time kicks in and your capital growth keeps appreciating on your capital growth property. Let's look at year 10. Your property is worth 778,000. This one's only worth 444,000. This one you're getting 31,000 in rental. This one's getting 44. You're still getting more, but it's catching up, isn't it? There's only a $15,000 difference. But look at the difference in capital growth. You're looking at $330,000. But let's have a look at what happens in year 20. In year 20, based on just 10% compounded capital growth appreciation, your growth property is worth $2 million. Your cash flow positive property is worth only $657,000. That means that you've missed out on how much growth? $1.34 million in growth. But have a look at the rental yield. $65,000 versus $80,000. So with your growth property, because remember it's 4% on the value of the property. Okay, this is 10% on the value of the property. So even though you're getting 10% here, you're getting a higher rental yield. The rental yield is lower here, but you're getting more cash in your pocket from this property. Remember, you can't bank percentages. You can only bank cash. So capital growth property outperforms cash flow positive property, both in capital growth and rental yield long term. And remember, this game, guys, is all about long-term planning. This is not about short-term gain, which is a get-rich-quick scheme and go bankrupt. This is a get-rich very slowly over 10, 20-year scheme. So this is a very important point because if I had a choice, and I've made my choice already, I'll only invest in capital growth areas. Number 7, waiting for the perfect time in the market to buy. Timing of the market versus timing the market. I often say to people, don't wait to buy property and wait. When you're starting out, what you want to do is leverage yourself as much as you can. Yes, have buffers in place. So for your first investment property under $500,000, I'm recommending having a buffer in $50,000 in an offset account or redraw facility, and then buying your property and gear up 95%. Remember, interest is tax deductible, and we're in a super low interest environment. It's unprecedented. Buy as much as you can quickly and then wait for a long period of time. Don't just stagger your purchasing of your properties over a long period of time. You'll never be able to guess the market, okay? And what you want to do is buy as much as you can, which isn't going to be that much anyway. You're going to be disappointed because people always think they can buy more than they end up doing, and then allow the market to wash over your property portfolio. And then when your property is double in value, you're just going to look really smart. You know, and I've experienced that many times when my properties have doubled in value in my portfolio. Some have tripled, and I just go, yep, I knew exactly that was going to happen. Not. But I knew the numbers. I knew that the area was going to grow in value. So don't wait for this magic moment when we're at the bottom of the cycle and everything's perfect. It's like going to the gym. When do you go to the gym? As often as you can. It's not about, it's 6 weeks to summer, let's go to the gym. You know, when you build a body, you do it during the winter. You know, you go to the gym 5 days a week, structured over a long period of time to get the compounding effect of results. Not going for the gym once and spending 6 hours in there and killing yourself. You know, that's not sustainable. Remember, we're here at the property market at the moment, 3 o'clock on the property clock, according to Harrington White Valuers. So we're going into a declining market. At the moment, I feel in my bones the market's already moved in Melbourne because I know that auction clearance rates are slightly up, investor inquiries are slightly up, interest rates have, the last cut we had just recently on Tuesday, plus there's going to be another cut in the future. I mean, it's going to stimulate the market. It still hasn't kicked off though. I don't know whether we've hit the bottom or not. I think potentially we could have, and the problem is that we're always looking back at the market because the best stats that we have are usually 2 or 3 months old. So we're always kind of looking back, there we were, back then. But I know it's going to be a very quick transition between here and there, and then we're going to go into the next growth part of the cycle. Now, the fastest growth is from 9 o'clock to 12 o'clock, which is just craziness. And I don't recommend buying property there. I recommend that you already have property here, and then you're refinancing your property and getting your equity out to go again. You don't be overpaying for properties because remember, majority of people buy at the peak and many of them sell at the bottom, and after taking into consideration stamp duty and agents' commissions, they actually lose money on the first transaction. So buy property long term, forget about timing of the market, it's time in the market. Okay, so I wouldn't worry about cycles at all. 20 years ago, I was really watching this. Now I just don't care. I just do as much as I can with what I have at any point in time. Maximise and take advantage of every week, every month. Buy as much as you can and then hold it long term. That's my advice. Because then the more you have up here, the smarter you're going to look. Number 8, taking advice from friends, family and colleagues who are broke and have no results themselves. You know, a famous person has once said, your net wealth will often be determined by your network, and your network will determine your net wealth. Surround yourself by people, if you can, and I know this is hard because it's easier said than done. If you're working in a particular industry, you're going to be surrounded by whoever works there. And you can't choose your family either, So a lot of times people take advice from the wrong people in their life, and this can hold them back. I often say to people, if your neighbour is such an expert, what is he doing living next to you? Most people with no results always have an opinion on something, but how much is that opinion worth? Often I say the most expensive advice is free advice. The cheapest advice is when someone's charging you $1,000 an hour to give you advice. So I would only take advice from people that have the results that I'm aspiring to or have achieved much greater results that I want. I don't care who's got an opinion about what. It's like going to the gym. I've been doing powerlifting now for nearly 20 years. If I'm let's assume I'm starting out again and I can't bench 100 kilos. Why would I listen to someone that can bench 50 kilos if I want to bench 100? If they knew how to bench 100, they'll be doing 100 kilos. It's that simple. The fact is they can't do 100 and they want to. And don't believe this bullshit, but I don't really want to. I don't want to get too big. Rubbish. They either can do it or they can't. So if I want to bench 100, I'll be listening to people who are benching 150, 200. What do I need to do to get to that level? Same with property investing. If you've got 2 properties, don't listen to opinions of people with 1 property. Listen to people with 10 properties or 15. Because those opinions will be very different and it has nothing to do with their credentials. There's a lot of accountants out there, guys, that are super conservative, anti-property. A lot of financial planners, super conservative, anti-property. So you've got to make sure that you're listening to people with actual results right now in the market. they're the ones I'll be listening to. I will take advice from a garbage collector with 10 properties over a financial planner that has his house, is completely broke, but he's got this persona that is actually in financial planning and wealth creation, because it's all about results. Nothing else matters. So take advice from people that are qualified to give you that advice, and qualifications are based on results and nothing else. Number 9, having a get-rich-quick psychology. And I see this every year, hotspots. You know, these stupid hotspots. Now, I'm not talking about hotspotting, by the way, because hotspotting.com.au is a phenomenal company, and they have really good reports on different areas around Australia, and they give you reports about undervalued areas, highest capital growth areas, highest rental return areas. I'm talking about speculative hotspots where people say this town's going to boom because this is going to happen. And the mining industry is a perfect example. You know, Adelaide had the Olympic Dam mine, which was shelved eventually. People bought houses all around there, and eventually nothing happened. BHP said, you know what, I don't think we're going to wait for this one. And they shelved everything. There's a lot of areas around Australia where people went in with the expectation of something happening, and it never happened. And I see these articles all the time in Herald Sun, even Fin Review. It's all these hotspot areas, and people think, ooh, hotspot, I'm going to get in and get out really quickly and make lots of money. That's a form of gambling to me. That's not really investing. Investing methodology is based on sound principles that are proven time and time again. Guys, it shouldn't be exciting. It should be almost boring and predictable. So invest in areas that have had good capital growth for the last 10, 20 years. Yes, that's a boring strategy. Yes, it's predictable, and those areas could be expensive. But that's why they are expensive, because they've had such a good run. Don't invest in cheap areas that are hotspots. There's a saying in real estate, cheap today, cheap tomorrow. You know, if an area is really cheap right now, why does it have to go up in the future at all? We've had a whole property cycle already, and we're at 3 o'clock now. If it's not going to go now, when is it going to go? You know, so I'll be very skeptical about hotspots and areas that are going to boom because some mine or some mineral or some resource or something will happen in the area. There's going to be a shortage of dwellings. So just be careful with that. That psychology, most of the time, people end up in tears and bankruptcy. I will stick to the fundamentals, stick to growth properties, major capital cities. Yes, if you've got 10 properties, you want to diversify and take a bit of a gamble, no problem. But to get a whole strategy based on this expectation of this mythical hot spotting and it's going to take off and you're going to make millions here, but you're getting in for 100 grand, that's not a good way to be. So I recommend that you be very skeptical about anyone claiming of any hotspots that are happening or any future boom areas of any major capital city or regional areas or mining towns, full stop. And international markets, forget about it. I've seen these things happen, end in disaster, people buying in different areas. And yes, people made a killing as well, but for every person that made a killing, how many people have lost money? So look at both scenarios, but I'm not here to tell you what to do, guys. I'm just here to share with you that I've seen people get caught up in this hot spotting, get rich quick schemes, and it always ends up in tears. Stick to the fundamentals. It works. So what really determines capital growth? Capital growth is not location so much. It's scarcity with high demand, but the right income demographics. People that have high disposable income and there's scarcity of stock. Therefore, what's the definition of low capital growth? Infinite supply, which is house and land packages in Melbourne, and having income demographics with very low incomes in that area. There's virtually no secondary market for those properties. Number 10, buying investment properties in the wrong structure, personal name versus corporate trustees and trusts. Now, I've done videos on this topic before, and I've actually got an accountant, James Blackley, did a video a few months ago on trusts and buying properties in the personal name. I'm not going to go into it in detail here, but I want to highlight a couple of key things. Number one is, if you want to build a very large property portfolio of 10 properties plus, you cannot do it under an individual's name. The system is designed for you to max out very quickly. You have to end up eventually in business banking, not consumer lending, and you have to be buying them in trusts. Okay? Now, for the first few, you might have a discussion with your accountant that if on income of $78,000, you're going to buy the first 2 in your personal name and then buy everything in trust. And that's cool. Based on independent advice, that could be the way to go. But I'm telling you now, you can't build wealth by buying properties in your own name because your serviceability will be maxed out very quickly. You have to end up in business banking of every lender, and that means buying properties in trust and corporate trustees. Asset protection has nothing to do with it. It's just that you're playing by different rules in business banking versus consumer lending. So when you're structuring your property portfolio, make sure also, if this is your house, your bad debt, and this is your good debts, your investment properties, make sure you never cross-collateralize your assets. Make sure they're structured as standalone, separate lender, separate structure. Whether this is in your name, and this is in your name, and this could be in a trust, make sure there is no link between them because you don't want to have a domino effect. If something happens to one, all the others topple over. You want to make sure if this one gets in trouble or this one, these ones are unaffected. This lender here cannot have access to these properties. That's a very important thing because that's where you're building strong foundations for your property portfolio. If you're building everything in your own name, if you get sued as an individual, everything can be taken off you. Remember, whatever gets grouped together can die together. But the number one reason you buy things in trust has nothing to do with asset protection. It actually has to do with the lending and business banking. And that's what a lot of people don't understand, which is a very, very important thing. So once again, this is something that I won't talk to you about in detail. This is something that is a topic for your accountant to discuss with you. And I have done another video on this topic a few months ago with James Blake from Brandy & Co. Now, having said that, I hope you enjoyed that video, and I want to summarize what is the key ingredients of building a large property portfolio. What are the key successful traits? And what are the things that you need? The ingredients, I guess, that you need to have in place in order to become successful. Number one is you definitely need the right psychology as an investor. And this is easier said than done. Psychology is the key ingredient that's going to make you implement strategies or not implement strategies. Number two, you got to have the right plan, the right system of acquisition, and you got to work backwards and translate that back into property acquisition, definitely. Then you got to get the right experts team around you to implement that strategy, and you got to have the right selection methodology to identify the right properties. And this is the very definition of success. So you got to have the right psychology, the right plan, the right team of experts, and the right property selection methodology. All of them overlapping, all of them synchronized is the very definition of success. If one of them is out of whack, if one of them is not working, you are not going to succeed. So for example, if your psychology is very negative around debt, which is probably the number one deterrent that stops people from building wealth through property, is they actually have a very adverse psychological reaction towards debt accumulation. They're scared of debts. Maybe their parents had issues with finance. Look, most people are financially illiterate anyway, so they don't understand debt and they just want to get rid of it. You can't accumulate debt and push debt away at the same time, okay? It doesn't work. So if you've got the wrong psychology, you want to pay stuff off and own it, even if you've got a good plan and good experts and good property selection methodology, you're going to end up with one property, I guarantee you, or two. And then you're going to be pushing everything away and justifying why it's always the wrong time to invest in property. You could be an accountant, a mortgage broker, an engineering person with very, very strong mathematical background, so you understand numbers and figures, but your psychology could be such that it's preventing you from building wealth. It's very common. If you've got the right psychology, you know you've got to use other people's money to leverage into wealth, etc., etc. There's no plan. You get the right experts and the right property selection methodology, you're probably going to be buying one or two properties and then stopping. Because why should you go any further? You know, you probably buy one or two and go, well, that's it, I've got the 2 properties now, cool, let's go and do some cryptocurrency or shares. Why should you buy 10 or 12? You've got no objective, there's no destination. You've achieved your objective, you're a property investor, you got your house, 2 properties, done, I'm done. All my friends have 1 or 2, 2 is good, nothing wrong with it. As long as you understand it's not going to get you to financial independence, that's cool. And for some people, that's all they'll do. If you got the right psychology, the right plan, and you've identified the right properties, but you've got really bad accountants and mortgage brokers, You're going to max out with your first property or your second, and that's it. And I'll tell you, oh, it's too hard, don't do it. Accountant will be telling you to buy everything in your own name, and the broker will be telling you, yeah, max out, can't get you any more money. It's APRA, it's the vibe, it's the vibe. If you've got the right psychology, the right plan, the right experts, but you're buying properties in Docklands and Point Cook, you're going to get no growth, which means you'll never be able to leverage the equity from those properties to go again. Which means, once again, you're going to end up with 2 properties or 1, and that's it. So you've got to make sure that you really have to master each part of this. That you don't have to become an expert on everything. You're just a generalist. I always say to people, you're like a GP. You know a little bit about everything, but you know who to go to, who the experts are. So you've got to get the right team, and you've got to get the right property selection methodology. If you're interested in learning more about these things, which I've just covered before, but in greater detail, I encourage you to attend one of my up-and-coming real estate investing fast tracks weekend, which I run 10 times a year, roughly every 6 weeks, 5 to 6 weeks in Melbourne, just here in my office in St Kilda. If you just scroll down below, you can see this URL there. You can jump online and register yourself. Tickets are free. It's a 2-day event. The first day is all finance and psychology, and a lot of market updates, but also how to build and structure your property portfolio from a financial perspective. So it's an in-class environment. Number 2 is all about property due diligence and research. We actually take you, put you on the bus, drive you around Melbourne, and show you the best areas to invest in and areas you should avoid investing in if your objective is for capital growth. These are great events. They book out really quickly, by the way. So if you are interested in booking tickets and getting a level of knowledge that's far beyond the average investor out there, then definitely I encourage you guys to attend that event. And I run about 10 of these per year. Also, if you want to get a copy of my book, jump onto bookonfinance.com.au or Amazon or any good bookshop out there in Australia, and get a copy of Australian Property Finance Made Simple. Now, as I mentioned at the beginning of the video, just because you stayed all the way to the end, I'm going to give you a free gift, which is access to my online home study worth $497. So even if you don't buy my book and you don't attend the event for free, I encourage you to access this education. It's absolutely for free. There's no strings attached. It covers basically everything I mentioned, but in greater detail, and including property selection methodology, right down to how to pay off your home loan in record time, and also all those important questions you need to ask your experts on how to pre-qualify your whole team of external experts. It's user-friendly. You've got a manual that you download, and then you watch the videos. It's about 10 hours of content. And what I did last year is I've just updated the finance section. So there's a 3-hour brand new finance section there with Stephen McClutchy that I've included in that home study. So it's about 13 hours now of content. It's yours to watch, absolutely free, no strings attached. All you got to do is scroll down below and check out the URL link, which is this one here, and just log in, and you can start watching and educating yourself on property investing in no time. Thank you very much, guys. It's been a pleasure doing this video for you, and make sure that you do subscribe to my YouTube channel, and hope to see you at one of my live events in the future. This is Konrad Bobilak, and I'll see you on the inside.